And we have a great speaker this morning on Talking Point. Sanjay Mookim, Head of India Equity Research at JP Morgan, joins in. Sanjay, we always love our conversations with you. Thank you so much for your time to us today here on the India Market Open.
To be on.
I'm
Thank you, Mary.
I'm going to start with how you've seen the earnings season in second quarter. It's been a pleasant surprise for most and good enough time to talk about it as we're closing it out entirely. Would you say more positive surprises and fewer shockers than expected?
I think you used the right phrase there, Tamanna. It is surprises, and we've argued for quite a bit that what drives stock prices is surprises rather than absolute growth in the short period of time. And what's happened is that in the early part of the year, so let's say the March and June, because commentary was weak, we saw earnings expectations get cut dramatically, right? So people right-sized their earnings projections for the full year and for, let's say, the September quarter. So in the context of expectations having come down, you've had a decent quarter. Of course, it's catalyzed by some policy actions that has been taken as well. But overall, I would agree with your assessment that that the June-September quarter has come in overall neutral to better than expectations. So it's a relief after many quarters of weakness.
What among the companies that have reported did you find standing out for you? And pointing to a larger story, is there a larger story of growth, of recovery over here?
So look, it's a very standard candidates. The banks have done well. The consumer companies have shown some life after a while. The auto companies obviously have had great numbers sales-wise. And it's more important that I would argue, Tamanna, that the commentary from companies is no longer as despondent as it was perhaps earlier in the year. So there's a change not just in the delivery and the volumes that's coming through, but there's also an improvement in the tone that you're hearing from companies, which is again a relief for the market. The question, the more important question, is whether this is sustainable. And we'll see. There are categories where we think that the impact should be durable and you should see sustained volume improvement for the next couple of quarters. There are categories where you could still have seasonal effects and where things might slow down again. So I don't think there's a uniform answer to say that it's all reset and you're going to get a major revival across the board. You will have to take a far more nuanced view on where the impact of the policy changes or the price changes is more durable and where it is not.
Sanjay, just before I ask you on that, because this is a lovely point that you're making, good morning, Neeraj here. I wonder if earnings recovery is a sufficient condition, even if it may be necessary, for the sentiment and the actual numbers of the markets to move higher from where we are right now. Is that good enough, or does it need some other catalyst in the form of maybe a trade truce or any other factor, or global mood improving, whatever?
I think, Neeraj, what you're suggesting is a marriage of the top down and the bottom up. So all the research that we've done over the last several years, we've argued that for bottom up, earnings revisions is critical, right? The first criteria that you filter stocks or stock selections on is the potential for companies to beat expectations and start to see positive revisions of the earnings, right? And that's how and the valuation filter actually ranks lower if you are at least a near-term investor. If you're a longer term, of course, you care about entry multiples because that determines future compounding quite a bit. So I would say that, look, we started to see at least some positive revisions sporadically bottom-up come through. The top-down argument that you make, Neeraj, may still be valid because global equity sentiment is relevant for India. However much we would like to say that we have decoupled, that's not necessarily the case. So if you have, let's say, a drawdown globally, that will translate to pressure on Indian equity markets as well. And conversely, like you said, if you get some relief on India's macro conditions through such as a trade deal coming through, that could probably be a small sentiment driver also. So I don't think we can ignore or say that one dominates the other. Bottom up, revisions matter quite a bit, and top down sentiment will be joined at the hip to what's happening globally.
Got it. So Sanjay, are we in a bottom up market currently for the next 6 months, or do you reckon there could be a top down rally from where we are right now on the valuations and the levels as well?
So I would argue, Neeraj, that once the earnings season is done, that the volume of news flow that you get out of companies actually slows down, right? And you were, let's say, the last 45 days very, very bottom up, focused on numbers coming out of companies, the commentary on analyst calls, etc. That should reduce a little bit, just by design, and you will focus a little bit more, I guess, on whether a trade deal is happening, what macro conditions play out, whether the RBI cuts rates and how much, or the Fed cuts rates and how. So I think at least for the next 2 months or so, it may be a more global tide that dominates.
Okay. Now, within that, therefore, if I would urge you to, Sanjay, make a confluence of that global tide turn if it were to happen, and therefore the areas to bet on, because you sounded in your opening two answers very specific or cautioning towards the need to choose right. It may not be a rising tide that carries all boats necessarily along with it, right? I thought that was your answer. So where is it based on the government action beneficiaries as well as the commentary that you've heard, do you believe will be the first amongst the equals in this whole array of choices available?
Right. So exactly that. So now look what has happened. You have seen two or three things happen, Neeraj. One is that there has been these tax cuts, and the net price to consumers has fallen across a broad range of categories. The second, and if I may point out, the RBI conducts these consumer confidence surveys, and even prior to the GST cuts, the urban consumer confidence data is ticking up, right? And the urban consumer confidence on discretionary items was ticking up even before the GST cuts came in. It's not a very big thing. It's gone from negative to neutral or something like that, but it is the right direction. So what I'd argue is that we look for sectors where the price cuts drive elasticity of volumes. We like the auto space as a candidate for that, Neeraj, because autos, we argue that many of that gets financed, so the amount of EMI you pay for your entry level, first level car is important as a decision for buying the car, and therefore you should continue to see volumes play out. A lot of company strategy also matters. Is the company taking the opportunity to drive its own volumes? And we can, obviously talk about some of those. I think the discretionary auto space is where we think the impact of price cuts can be a little bit more permanent in other places.
Extend that and the interest rate cut trajectory, Sanjay, to real estate as well?
Look, there are two things as far as we see Tamanna on real estate. One is that in several micro markets there is a concern of oversupply, and you will see this all the podcasts that the developers themselves are doing, saying that Mumbai, for example, is oversupplied for some time. But what we are encouraged by is that there is still volumes that are going through. The pre-sales numbers are holding up, and I think the market is not fully appreciating the fact that the real estate business has gone from relying on price cycles to becoming a capital churn model, right? Where you build, you sell, you collect your money and move on to the future projects and next project. So I think that the reduction in rates, if the rates have already come off, if they are cut more, should be another tailwind to the real estate market. And I wouldn't necessarily be focused on the stagnation of prices or the discounting that may start to happen.
In terms of global headwinds as a factor, do you see that receding, Sanjay? I mean, I know we're waiting for the trade deal, whenever it comes, whatever happens there, but metals, export-oriented companies, this was a big pain point, I would say, even a couple of months ago. This seems to have eased, at least optically. Do you think this has receded in terms of pressure points in the context of Indian markets?
Well, I'd say, Tamanna, it is very difficult to imagine how global uncertainties and volatility, at least policy-wise, gets any worse. Right? I mean, it's already, there's too many things going on. There's too many variables, and it's very intriguing to see why equity walls are so low in the context of all the policy uncertainties, the geopolitical challenges that we are facing. So yes, it does look that we have maybe hit a peak. Whether many of these things get sorted or not, I don't know. But it's difficult to see how. I mean, I hope it doesn't get any worse than it is.
And then do you think that that becomes a factor for FIIs to look at India favorably again? How important is FII interest in India now as a factor for the domestic markets?
Well, look, if you look at ownership, the total local institutional ownership, if you take MFs and insurance, is now higher than FII. So it's not as dominant as it used to be. However, if you split it out, then FII still dominate ownership of the large caps, right? So if you look at, so on aggregate, locals are now equal or more than FII, but FIIs continue to dominate ownership of the large cap stocks, the large banks and the large, broadly the large sector stocks, right? So you do worry or tend to worry about inflow and outflow for large cap index performance or FII or a very tactical basis. But I would argue that look, it's not necessary that just because let's say the AI momentum slows down, that you'll suddenly see a flood of money coming into India. There has to be ultimately a growth differential in my favor. I need to start to deliver better growth, in contrast to the growth that is available elsewhere in the world. So if that becomes a view that look, Indian growth is holding up, whereas growth everywhere else is slowing down, that I think is the trigger for flows to come back to India.
And Sanjay, just that, are your clients therefore saying that they want to see that evidently, and will they take a decision after a couple of quarters of seeing that, or could money precede the first signs of this thing coming in? Because usually markets smell something way before it actually happens.
Yes, but in this instance, Neeraj, if you break it up, right? So if you look at what has been driving the growth, let's say we have been upgrading our US GDP growth forecast. And a lot of that has been specific to the AI capex that is being conducted, right? It's large, massive numbers. And therefore, it's been extremely difficult for anybody to get ahead of it. You would have said, oh, look, this is excessive 3 months ago, 6 months ago as well. But we've still been upgrading our US growth numbers in the interim. So I don't think anybody is going to be brave enough to call the turn ahead of it happening visibly, to my mind, because these are massive numbers across the world.
Okay. Sanjay, lovely talking to you as always. Thanks for taking the time out and dissecting a lot of key things for us.
Thank you. Pleasure to be on.
Yep, likewise. Great having you. Well, that's the JP Morgan view on a bunch of things, including FI return and sectors that they have found merit in after the Q2 numbers.